But the whole idea of building long-term wealth in the market by investing in ETFs and index funds isn't as attractive as they used to be. People really have become accustomed to the whole idea of seeing fast returns in the market. If you ask anybody, would you rather get rich fast or get rich slowly? Everybody's gonna say get rich fast. It's just like when I go and buy a guac making kit on Amazon. When I go to the checkout page, it's gonna say, would you rather receive your product on Tuesday for free, or would you rather receive it on Thursday for free? I'm gonna pick the Tuesday because that lets me make guac sooner. And it's the same reason why the buy now, pay later companies are one of the fastest growing companies in the entire fintech space, is because when people want something, they want it now. Even if I can't afford it. If I want to buy something, why should I have to wait until I can afford it when I can just buy it now and pay for it at some point in the future? Now, if you're watching this and you have that minority mindset, you're gonna say, well, that's a really bad idea. How would you want to spend money that you don't have? And you're right. There's a cost with all of this added risk that you take. There's a cost for buying something now and paying it later. It's called interest. There's a cost for receiving your Amazon packages today. It's called paying the Amazon Prime fee. And there's a cost for wanting to see the fastest returns in the market. It's higher risk, which means there's a bigger chance that you can see a bust in your investment portfolio. Part of the reason why people are so attracted to the idea of getting rich quick in the market is because, well, they feel priced out of the economy. Millennials are the fortunate generation to deal with the most amount of student loans in history, which is why they're struggling to buy homes, struggling to buy cars, and on top of that, they've already lived to 2 once-in-a-lifetime recessions. All of these factors have been coming together to create a whole new movement of young people called anti-work. And if you're like me and have no idea what anti-work is, well, let me show you. According to Reddit, anti-work is unemployment for all, not just the rich, and this is a community of people who want to end work and want to live a work-free life. This anti-work movement gained even more popularity after a moderator from the Reddit subforum went on to Fox News and talked about the philosophy of anti-work, where he says that he is a dog walker and he would prefer to work even less than he is now, and he has the goal of one day becoming a teacher to help spread this message of not working to the people. And after that interview, people either loved or hated the anti-work movement. Now, whether you're pro-work or pro-anti-work, at the end of the day, it costs money to eat, and if you're not working or don't want to work, you're gonna need money from somewhere. And so this is what pushes even more people to make riskier decisions in the stock market. That way, hopefully you can see something pop, make some money, and then live your life without working. We are entering a new economy and a new market now where we're going to see less support from the Federal Reserve Bank. After the 2008 financial crisis, we saw the Federal Reserve Bank slash interest rates to near 0% to help stimulate the economy and help people go and invest their money into the markets to help prop up the markets. And interest rates were left around 0% until 2017, when the Fed really started to raise interest rates, and this happened until 2019, because in 2019 President Donald Trump put a lot of pressure on the Federal Reserve Bank to cut interest rates to help grow the economy even faster. So at 2019, the peak, we saw interest rates go up to right around 2.5%. Then in 2019, that's where interest rates started to get cut again to help stimulate the economy. And then came, well, as we all know, 2020, the pandemic, the recession, and as soon as that hit, the Federal Reserve Bank slashed interest rates all the way back down to 0% again. When you're in an environment with low interest rates, this is a time where the economy can grow faster because people and corporations and banks can borrow money cheaper. People can go out and borrow money to buy a home. Corporations can borrow money to invest back into the businesses, and banks can borrow money to invest it back into, well, other companies. But fast growth isn't always sustainable. I mean, if my goal as a company was only to increase revenue, which is often what happens when you see interest rates so low because people are investing their money into companies hoping to see the fastest growth. If my company is in the business of selling dollars and I'll sell you a dollar for 95 cents, guess what? I can increase my revenue just by saying, all right, I'll sell you a dollar for 90 cents. Now, you give me 90 cents, I'll give you a dollar. And on paper, it's gonna look like I have big revenues. I have higher expenses than revenue, but that's very common with some companies. But I can grow my revenue just by cutting my prices and not making any money. And so now, as you enter a time where interest rates go up, This is where it becomes even more important and more crucial for companies to be producing real value and real money, because if you're not, it becomes more expensive for investors to have their cash tied up into your company. That's one of the reasons why you've been seeing so many momentum and tech stocks crash in 2022, because investors are worried about these rising interest rates, and because of that, they've been moving their money away from companies that aren't producing real money, and they want to move them into companies that are producing money. One of the best pieces of stock market advice that you can follow is Warren Buffett's 2 rules of investing. Rule number 1 is don't lose money, and rule number 2 is, well, don't forget rule number 1. If you don't want to lose money in the market, one of the easiest things that you can do is to stop being a trader and become an investor. An investor is somebody that invests their money into the market for the long term, because when you invest your money over the long term, now you're lowering your risk and you're letting the economy do its thing. I mean, if we look back at the 100-year chart of the stock market, you'll see that the stock market has gone up. Now, this doesn't mean that the stock market goes straight up. You'll see the stock market crash in the Great Depression. You can see the stock market crash again in the 1970s when we were facing super high inflation. You see the stock market crash again in the 2008 Great Recession. So if you zoom into the stock chart and you only look at 6 months or a 1 year or a couple year period, you might see a lot of volatility. You might see the stock market go down and you might say it's a bad investment. But if you zoom out and you look at the stock market on a bigger picture, what you see is, yeah, you see these ups and downs, but over the long term, the stock market goes up. So the person who makes the most money in the stock market is not the person who's trying to time the market. It's not the trader trying to flip the stock market. It's the investor who has the patience to let the stock market do its thing and invest their money over the long term. Now, of course, you can get better returns if you know how to analyze companies, if you know how to read companies, if you know how to find an undervalued company. If you want to learn more about how to do that, you can get a free trial to Market Insiders, where you get weekly access to coaching sessions from real estate, stock market, and cryptocurrency coaches. So if you want to check that out, I'll put a free trial to how you can do that with Market Insiders in the description below. But the biggest lesson that I learned through some very expensive mistakes is that if you are not willing to put in the work to research companies, keep up with companies, and listen to earnings calls, then what you should be doing is not investing in individual companies and then investing in either ETFs or index funds, because now these types of funds will give you exposure to the general market, and now you're just investing in the stock market itself, and you don't have to worry about trying to find the perfect company. Because what happens when so many people try to find the perfect company to invest in is you invest in a company, you see it go down, and now you start to panic. Oh no, I invested in Amazon. Amazon's going down. Is Amazon going to go bankrupt? Is this the end of Amazon? Did I buy it at the peak? And so people get worried, and then they tend to panic sell. But if you're investing in these funds, now you're investing in dozens, if not hundreds of different companies. You can go out and invest in ETFs or index funds that give you exposure to the S&P 500. The S&P 500 is a group, an index of the 500 biggest companies on the stock market. Now, instead of you going out and trying to find each one of these 500 companies and monitoring each individual one, you can just invest in a fund that gives you exposure to these 500 companies. Now, if the economy grows, well, chances are this index fund or ETF will also grow, and you don't have to do anything. You just keep passively investing your money every week, every month, and you let the market do its thing. If the market goes down, you buy more. If the market goes up, you just keep buying consistently. This is one of those things where you have to give it time to grow, you have to keep consistently investing, and you have to keep automatically investing. The difference between an ETF and an index fund is an ETF you can trade just like any other stock. It has a ticker symbol, you can go onto any trading app and buy an ETF. Index funds have more restrictions than ETFs. Many index funds are going to have minimums as to how much money you can invest. Some index funds are going to say that you have to invest a minimum of $1,000. Others might say $2,500. Others might be $10,000. And other index funds are also going to have restrictions on when you can buy and sell. A lot of index funds only let you buy or sell one time a day, versus an ETF, you can buy and sell them just like a stock. But you have to remember that the goal with both of these is not to be trading, it's to be investing for the long term. That's where the money is made. Now, while this strategy might not get you the most likes on Wall Street Bets, the reality is this works. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.